In this example, we're going to be going through a master budget problem similar to what you might see in a textbook problem. So the way we have this set up, we're going to be using Excel for it, and we're going to be talking about referencing and linking. So I have a data sheet overall that we're going to be using first of all, and we're going to use a lot of these different pieces throughout our problem. So I'm just going to and you'll see we have several different tabs we're going to be using. We're going to talk about each of them. So let's go to the sales budget first of all. In this case, we're going to reference everything back to the data sheet, or at least another cell, so that when we update something in the data sheet, it's going to automatically update each of these tabs. So the way we do a reference, a simple reference, is we type equals into the cell in question, and then we go over to the data sheet and pick whichever cell we want to reference. So now you'll notice, here's my reference. If I was to update this cell here, let's just update it to 9,000 really quickly. It updates here automatically. We'll go back and change that. Now I want to get May's, so I'm going to pull it down. Now notice in one tab it goes left to right. In this tab it goes top to bottom. So there's not a great way to easily do this quickly, so you have to go back and forth to each one. We're going to see that we need July and August as well, even though that's outside of our quarter. We'll talk about why in just a little bit. I have the explanation for why down here, but we'll get to it in a little bit later as well. The quarterly is just going to be a sum of these 3 months. Now the price per unit is going to be the same amount. It's going to be $51. So I could point every cell to $51, or I could reference this cell each time, or an even better way is to change your current reference to a static reference. Now what I mean by that is if I was just to take this cell and drag it over to copy it and paste it, now it's 0. What it's doing is for each time I move to the right, it's also moving to the right in the data sheet, and there's obviously nothing over here. So instead of doing that, I have to click right before the column reference and put a $sign, which is a string. It turns that into a dynamic variable or dynamic reference. And now, it changes it from dynamic to static. It's dynamic if it doesn't have the $sign. It's static if it does. What that basically means is now no matter where I put that reference, it's going to keep pointing back to C in the other sheet. The next part is just simply multiplying the number of units by the price per unit. That I can carry over without any trouble because we do want it to update to the new columns. So that's the sales budget. Pretty straightforward there. With the production budget, we're going to have a little bit more to do. First of all, we have to reference the sales budget to get the number of sales units. So I'm going to do that. Now the good news here is since everything is formatted the same way on the two budgets, if I just simply drag that and copy it over, it's going to actually pull 85, 18,000, 21,000. So it'll pull the proper numbers. Now, I could do that for July and August, but it'll create some formatting issues with that F. It'll try to put a border on it. So I'm just going to jump that column and then go back and carry it over again. Again, we'll talk about why we need July and August. Desired ending inventory. That's the 20% of the next period's sales units. And we'll see that same thing down here. The company has set a policy that the ending finished goods inventory should be the following percentage of next period sales units. The percentage is 20%. This policy has been followed in the prior period, which we'll see why that's important in just a bit. So for now, I'm going to refer to that 20%. Whoops, and then I'm going to multiply it by the next period sales units. Now I want to drag this formula over for a while, but to do that I have to put my dollar sign in front of the D so it doesn't try to change it on me. But the problem is I can only drag it over one. It's going to point to June. It's going to be 20% of June. But if I drag it over again, it's going to be 20% of the quarter, which makes no sense. So what I need to do here is refer back to my 20% multiplied by July. So I have to point to July now. That's why we had July, is to figure out the desired ending inventory of June. The quarterly ending total is going to be the end of the last month of the quarter. For July's desired ending inventory, which again, we'll see why we need that, it's going to be 20% of, so back to their 20% of August's sales. That's why we needed August sales. Now the total inventory requirements is just the first two rows added together. I can drag that over without any trouble. Now beginning inventory is the one that's a little bit tricky here. If we go back here, it says this policy has been followed in the prior period. So in the prior period, which in this case would have been March of last year, or March of last quarter, we would have had ending inventory of 20% of April's sales. So even though we don't have March's ending inventory, we can predict what it would have been. It would have been 20% of April's sales. So if the problem you're dealing with actually gives you March's ending inventory, which becomes April's beginning inventory, go ahead and use that. But in this case, it didn't give us anything for March, so we had to calculate what it should have been. Now, for the other months, it's simply going to be the 20% multiplied by the next quarter's sales, or the next month's sales. For June, we have to go all the way over to July. And for July, we have to go all the way over to August. The quarter for the beginning is going to be the first month of the quarter, because that's the beginning of the quarter, and we're going to go there. So budgeted production. We know that somehow we need to get 12,100 units, but we've already got 1,700 units, so we subtract those out. That means we need 10,400 more. We can carry that all the way over, and we can do the same thing with July. So we need to get 15,000 units in July. We are now done with the production budget, and we're going to see the materials budget follows a very similar pattern. We'll see that here in just a second. So now we're on to the materials budget. What we're going to see here is that this follows a very similar pattern to the production budget. There are a couple additional pieces we'll see though. But the first thing we need to do is link back to the production budget, because we need to know how many units we're going to produce before we can know how many pounds of materials we need. So I'm referencing back to the production budget. Now again, since the formats were the same, I can actually drag this over and it'll still link to the proper columns in the other budget. Now we need July's production needs, which we had, 15,000. We don't need anything from August though, so we're good to go. Pounds of materials per unit. So we're going to link to the data sheet tab, and it says here that the materials required for each product are 7.5 pounds. So again, I'm going to go back to the reference and put a dollar sign in it. That way I can drag it over. Or in this case, I can actually do a copy, paste, and it should be good to go there as well. It's always referencing D13 no matter which cell I click in. So now I need to multiply these two to get the actual pounds of material needed in total for all that production. Now, desired ending inventory. Similar to production budget, that's going to be 20% of the next period's material needs. So 20% multiplied by the next period's material needs. So the cell right above it. So I can do that. Well, again, I forgot we had our reference to D16 that I needed to put the dollar sign in front of. Then I can drag it over if I want to one more time, but June I can't do that because I don't want to reference a quarter, I want to reference July. So 20% multiplied by July's production needs. So now you see why we needed July and August. We needed August to determine July's production needs, and we needed July's production needs to determine the desired ending inventory for June. And that's all we needed it for. The ending inventory for the quarter is the ending inventory for the last month of the quarter. We can add up our material needs, materials for current production plus the desired ending inventory. And that cell we can carry across without any trouble because it's updating to the new columns each time. Beginning inventory is going to follow the same thing. So earlier we said, hey, this policy has been followed in the earlier period. It's still 20% of the next period's needs for current production. So we assume that March followed the same thing because they told us. So March would have had 20% of the materials for current production. And for May, it would have simply been April's desired ending inventory. And you can see what I was doing here just quickly is I'm doing 0.20, so 20% multiplied by the current period's production, and indeed that was 27,000. I just typed it in there just to show you. So June's beginning inventory is May's ending inventory, 31,500. And then for the quarter, the beginning budget, beginning inventory for the entire quarter is the first month's beginning inventory. Now we know how many materials we need to purchase. So we have our material needs minus what we already have in beginning inventory. Carry that over. We have a cost per pound, which is back on the data sheet. It is $2.50 per pound. So I'm just referencing that. Now again, I'm going to carry that over, so I have to put my dollar sign in front of my column. Then I can drag it over. And now it's going to be the cost of materials is going to be the material pounds to purchase multiplied by the cost per pound. And I don't need to put the dollar sign there to drag it over because I do want it to update each time. So now we're done with the materials budget. The labor budget is pretty straightforward. We're going to move on to that one. We're still using budgeted units to produce. So we're still going to carry the same cells over. And again, I don't really need to type it in each time. I could drag it over, and for that matter, I can drag it all the way over here because I want the cells to update to the new column. It's just because of the way the two budgets were formatted in the same manner. Hours of direct labor needed per unit. So for this, I've got to go to the data sheet, and it says we need 2 labor hours per unit. So again, if I want to drag it over, because it's only that one cell, it's not in every column, I've got to put my dollar sign in front of it, and then I can drag it over, and we'll be good to go. Direct labor hours needed in total for that month is simply the number of units multiplied by 2 per unit. Drag that over. And then we have a cost per hour, which was $12 per hour over on the data sheet. Again, I have to put my dollar sign in front of it, my string value, and carry that over. And now my budgeted labor cost is just the number of hours multiplied by the $12 per hour, which I can again drag over. And that's as simple as the direct labor budget is. It's easier than the production and materials budgets because we don't have beginning or ending inventories. So just really referencing and some simple multiplication, and we're good to go with the direct labor budget. Now we'll talk about the manufacturing overhead budget. So with the manufacturing overhead budget, it's going to be somewhat simple because there's no beginning or ending inventories, but we have a few additional lines we have to worry about. So it's still a production-related budget, so we're still going to have to reference back to the number of units produced. And again, I can just drag that over now. Now, I do want to mention one thing here. This label said budgeted units to produce. So let's go back to the data sheet for a second. It says this company has variable manufacturing overhead per unit produced of the following. So $475 per unit produced. It's variable overhead. Every unit you produce has a little bit more overhead. Now, some textbooks, quite a few actually, simply use direct labor hours. The number of hours used multiplied by some rate gives you the variable overhead that you're applying. Sometimes they'll use machine hours. So we're just using the simple per unit produced here. That's why we're referencing back to the production budget for our number of units produced. If our manufacturing overhead was instead applied based on number of labor hours, we'd have to go to the labor budget and grab these direct labor hours needed. So just read the problem closely. The variable overhead rate per unit was given to us as $475 per unit. Now again, it's just one cell, but we want to drag it over, so I need my dollar sign there. We can drag that all the way over. And now we have our variable overhead is just multiplying those two together, the number of units by the cost per unit. Now we have a couple of additional items, fixed overhead items, depreciation, utilities, insurance, and property taxes. So I'm going to go back to the data sheet to reference that. It says it's $4,500 for fixed overhead depreciation, but it's monthly. Let's do utilities and insurance and all of that as well. Now again, it's monthly, so we need that in every single month. So I'm going to go ahead and put my dollar sign in there for both of them. And then I'm going to show you that we can actually drag 2 rows at a time if we want, or multiple rows. I don't want it in these last 2 columns, or this last column, because that's actually a sum of these 3 months. I'm going to drag this one down, and it'll carry down to the new row. So our total budgeted overhead is the variable plus the 2 fixed. I'm going to drag that over because it'll be the same formula, just in different columns. Now let's go back to the data sheet for a second to see what's going on with these last 2 lines. It says 8. The company wants to calculate a predetermined overhead rate per hour for future planning purposes. So different problems will give you something different. In this particular case, now we want a total overhead, variable and fixed, per hour. Sometimes they'll reverse it and the variable overhead will be applied per hour, and then they want a predetermined overhead rate per unit. Either way is fine. Just read the problem closely. But since they now want direct labor hours, we need to go to the labor budget. And again, if we carry it across, it'll work because it's now moving from column to column like we wanted. So if we divide the cost by the labor hours, Notice it's going to be different, or it could be different for each quarter, or each month end than the quarter in total. Even though the variable rate was the same per unit, the fixed overhead is different. And for that matter, we're not even using units down here, we're using hours. So those could be different as well. So just keep that in mind. We're going to see that the selling general administrative budget follows a very similar path as this manufacturing overhead budget. The big difference here is now we're using number of units sold because it's not a production type budget. It's related to selling costs. So we need to go to the sales budget to get the number of units sold. We'll drag that across. And now we need to go back to the data sheet to get a variable selling general administrative overhead rate. Here it says it's $3.25 per unit sold. Again, we want that same formula dragged across, so we have to put our dollar sign there. Drag it all the way across. And if we multiply the number of units by the $3.25 per unit, we get our total variable selling general administrative overhead. But now we have a few different items that are fixed. So we're back to that same thing. We're just simply referencing the information they gave us. Now the good news here, because each of these were in the same order, I can just drag this column down, or this formula down, and it'll increment it by one row this time. Since we're going up and down, it'll increment it by rows. When we did it left to right, it incremented it by column, but now it's increasing the row. If you want to check, let's just double check depreciation. Here it says it's 14, and sure enough, it was 1,400. So now the other good thing is, now that I have that, I can carry it all the way across. Well, except for one piece. Since now we're going across, I need to put my dollar sign in so it sticks to that same column. I need to do it for all of them. Now there are other ways to actually change these to variable, change these from variable references to static references. But that's a little bit outside of the scope of what we're doing here. Just trying to give you some basic tools for Excel. So we see the same amount has carried over. Total fixed selling general administrative expense is going to be the sum of all of these fixed items. We can carry that across. And now they want total budgeted, so total overall, it's going to be your fixed plus your variable. And carry that across. So now we have the selling general administrative expense budget as well. The next one we're going to talk about is the cash receipts, disbursements, and then the overall cash budget. So now we're on to the cash budgets, and I will mention that these tend to be the more time-consuming, even though they're ones that maybe make more sense to you from a personal finance perspective, because you're probably more familiar with cash budgets than any of these other budgets. There are some complexities when you bring in a business that we have to talk about. So we've split the cash budget into two: cash receipts, cash disbursements, and then we're going to do an overall cash budget. So we have a couple of cells here that I'm referring to as informational only. Beginning accounts receivable balance, that's what AR is, and ending accounts receivable balance. So these are informational. These are going to be needed for the balance sheet when we get to that particular statement. But let's go back here to the data sheet. We need to talk about some information. First of all, they give us the ending balance of accounts receivable for last month, which we'll need. They also give us the ending balance of accounts payable, which we'll need in the cash disbursements budget. Just keep these in mind. Now, for all the sales we had from our sales budget, some of them are cash sales. In this case, 30% are cash sales, and it says the rest are credit sales. So the cash sales we obviously collect that month. There's no question. We collect it right away, the month of sale. Out of the credit sales, which remember, that's the other 70%. So now we have a separate amount altogether that are credit sales. Out of that, 60% are collected that month, and the other 40% are collected the month after the month of sales. Now, at first glance, you may say, well, these 60 and 40 doesn't equal to 70, and that's correct. What we're saying is out of that 70%, it's a new pool. We want to do 60-40. So this 60 and 40, that's 100% of our new 70% pool. So we'll see how that comes into play in just a bit, but I just wanted to point that out. So this is our credit sale pattern. Now, I went ahead and set this template up to make it a little bit easier to follow. First of all, I want the informational only beginning AR balance for April. That's March's ending accounts receivable. That's usually how they're going to give it to you. They're going to give you the prior month's ending balance. Whoops, I didn't quite reference it all the way. Let me try that again. They're going to give you the prior month's ending balance, and you just need to carry that forward. Keep in mind what this basically means is we are going to collect this. It's March's accounts receivable. We're going to collect it in April, because this March's accounts receivable is basically the 60% of the credit sales for March that weren't going to be collected until April. Now we're collecting them. So we'll talk about that in just a bit. That's going to be added into our calculation down here. But we're also going to need 30% of April's sales. So first of all, we need to grab the 30%. And then we need to go to the sales budget and grab April's sales dollars. So now we have two things so far we're collecting in April. March's last bit of credit sales, April's cash sales, and we're going to collect some of April's credit sales as well. It's going to be 70% multiplied by 60% multiplied by the sales. So the data sheet. Now what we have to do here, this is a little bit tricky the way it was set up. So I'm going to do, well, in fact, let me do this a different way to make it a little easier. The way I have it set up, we don't have a 70% anywhere to reference. So what I'm going to do, I'll show you one more thing. We need to get 70% somehow. So what it's going to be is 1, notice I'm putting this in brackets, by the way, 1 minus this 30%. I'm going to close the bracket. That basically gives us 70% in our formula. Now I'm going to multiply that by 60%. Now we have 60% of the 70% that were credit sales, and I'm going to multiply it further by April's sales. So in other words, 182,000 of April's sales are going to be collected in April. That's it. We have three things we're collecting in April. Last month's accounts receivable, plus this month's cash sales, plus the portion of this month's credit sales that we're collecting this month. Now, the ending AR balance. That's going to be, I'm going to do our brackets again, 1 minus the 30%, close the brackets. Now it's going to be multiplied by the 40% that we're not collecting until next month. 40% of April's sales. So what that basically means is this is not going to be added into our cash receipts for April. In fact, it gets carried over to May. May's beginning AR balance. So that's what we're collecting in May. Now notice the exact same thing is actually down here. The 70% times the 40% collected in May. So we could do it a couple of different ways. We could just leave this blank and just use this number. Or we could actually recalculate it here and then ignore this number. Whichever way you want to do it. It depends on how the template is set up. For April, we could have actually had a line that said March's sales collected in April, but I just didn't do that. So let's go ahead and do this. In fact, I'm just going to take, well, yeah. I'm just going to go ahead and take this number. We already know what this amount is. We've already calculated it. So I'm just going to carry it down here, and then we'll just ignore this number in our calculation. Now we need 30% of May's May sales, which are cash sales. 30% multiplied by May's sales dollars. We're good to go there. And then now we're going to do that same thing. 1 minus the 30%, close the brackets, multiplied by the 60% we're collecting that month, multiplied by May's sales. So these are the three things we're collecting in May. But again, we need to know the ending accounts receivable balance, so we're going to do the same thing. 1 minus the 30%, 1 minus 30%, because those are credit sales, multiplied now by the 40% that we're collecting next month, multiplied by May's sales. This is the amount we're going to collect in June. So for June's beginning AR, I'm going to go ahead and reference that cell. And I'm also going to reference it down here for May's credit sales collected in next month, which is June. It's the same number. Now we have June's cash sales, which is 30% multiplied by June's sales. And then finally we have June's credit sales, so we're back to the 1 minus the 30%, close the brackets, multiplied by the 60% we're collecting that month, multiplied by June's actual sales dollars. These are the three things we're collecting in June, but we need to know what we're collecting next quarter, next month. We're still at the 1 minus the 30%, close the brackets, multiplied by the 40% we're collecting next month, multiplied by June's sales dollars. So this $299,880, that's going to carry over on the balance sheet to next quarter. That also becomes the quarterly ending accounts receivable balance. For the quarterly beginning, we have to go all the way back to the first month's beginning. So when you're doing this, the way this template is set up, when you're doing this total cash receipts from customers, you have to be careful to not duplicate anything. And we don't want the ending AR balance. We're not collecting that. That's the whole point. We're not collecting that period. So we're going to go ahead and, for April only, we're going to select this first cell, and we're going to select the other two. For May, the way we had it set up, we're going to grab these three in the middle. We're going to ignore the two informational cells. And for June, we're going to kind of do the same. We're ignoring the two informational rows, just grabbing those three. For the quarterly, we're going to have to do a sum of these three here horizontally. And now we have our cash receipts. This is going to be important. We need to know what we're actually receiving in a particular period. And then later we're going to deal with what have we paid for that period. That's the cash disbursements budget. So we'll see that here. We're moving on to the cash disbursements budget now. There are going to be some similarities to the cash receipts, but we have a few additional things to talk about. So first of all, let's jump back and see what our payment pattern is. For the materials purchases, it says that we pay for 40% in the month of sale and 60% in the next month. So we don't have to worry about a cash split this time. It's just 2 months, this month and next month. So it's a little bit easier. So the beginning AP balance would have been the amount from March that we didn't collect, and they've actually already given that to us. The ending AP balance for March is $215,000. So we're going to pay that. I shouldn't have said collect. We're going to pay this amount in April. Plus, we're also paying for 40% of April's purchases. So we're referencing the 40% first of all. This 40% down here, multiplied by the materials, because that's what this all relates to, is what did we purchase of materials. So those are the only two things we're collecting in April. In fact, we're going to add a few other things, but those are the two that are going to make it down here to the total. Now, ending AP balance. This is going to be the other percentage, the 60% that we pay next month, multiplied by the materials for April. So that's that $134,100. First of all, is going to link right back up here to May's beginning. But also, that's the calculation we need for this 60% of purchases of April inventory purchased or paid next month. So really, we don't need to do the calculation again. We can just refer to that cell. As long as we link it to a cell that had a reference, it'll update just as well. The other thing we're paying in May is 40% of May's purchases. So May's purchases here, these are the two we're paying in May. What we're not paying in May, we're going to pay in June, is the other 60% of May's purchases. If we go back up here, we can just link to that for June's beginning AP. And down here, we can link to that again for May's inventory paid in June. The other thing in June is going to be the 40% of June's purchases that are going to be paid in June. So those are the two. Each of these months is going to have two things they need to add together. Ending AP for June is going to be the 60% of June's purchases that we're not paying until next quarter, which that also becomes the quarterly ending balance. The quarterly beginning balance is the very first month's beginning balance. So that part is similar to the cash receipts budget, but we have a few additional things here. First of all, we need to bring in labor cost. So we're going to go back to the labor budget, and this is simply the cost for that month. There's no trick to it. In fact, we can take this formula and carry it all the way over. No trick. Now, there is a slight trick for manufacturing overhead and selling general administrative. The key thing is there's something called depreciation, which if we go back to the manufacturing overhead budget, we had a separate line for it. We have all of our depreciation. We're going to pay for all of it in that current month, except for depreciation, which is not a cash expense. It's going to be on the income statement. We need the full expense for the income statement, but it's not actually a cash expense that we pay that month because we purchased that asset years ago. We paid for it then. So what we need to do here is for the manufacturing overhead cost, we're going to reference the total budgeted overhead, but we're going to subtract out the depreciation because we're not paying cash for that. The good news is, since the formatting is the same, we can carry it across, and just you might want to double check just to make sure everything went properly. Selling general administrative is going to be the same basic thing. We reference the selling general administrative budget, total budgeted expense, but we subtract out the depreciation. Again, we can drag that all the way over. So our total cash disbursements, let me go all the way up here. We need to take our, for April, we need to take the beginning AP balance because we're paying in April, plus this $89,400, plus these three items. Now, we can't carry this formula over because the rows are different. So in this case, it's going to be these two material purchases plus these three other costs. So just be careful when you try to drag the formulas over. Make sure everything was going to be the same anyways. Make sure all the rows are in the same place. For the total quarterly cash disbursements, we can just sum those three up. We're done with the cash disbursements budget. Now we can move on to the overall cash budget. So for this one, we have a few new things to add in. First of all, we're going to have a beginning cash balance, which we have to get from March's ending cash balance. And as you can imagine, we go to the data sheet for that. The March 31st ending cash balance was $28,000. Now, we're going to add in our cash receipts. This is from the cash receipts budget. It's simply the total cash receipts for that month. In fact, that one's nice and easy. We can drag that all the way over because they were formatted the same. Now, the cash available is simply going to be beginning cash balance plus cash receipts. Even though we don't have anything yet in these other 3 months, we can still drag the formula over, and it'll be updated once we fill this in. Cash payments or cash disbursements are going to come from that budget. Now remember, that was after depreciation, so we're good to go there. We can drag that formula over. And we get an ending cash balance before financing, which is simply going to be the cash available minus the cash payments we have to make. So we have $105,270 ending cash. Now, there's something called a minimum cash balance desired. Let's talk about that for a second. Let's go back to the data sheet. It says this company desires a minimum cash balance of $20,000. If the cash balance falls below that amount at the end of the period, they're actually going to borrow from their credit line at the following annual interest rate of 12%. Now, I put 12% in there because we're dealing with months. So 12% divided by 12 months is going to be a simple 1%. That's why I use that. They also pay back any debt, principal, and interest at the end of the month in question. But the good news is, for this month, we're well above $20,000. I'm going to go ahead and reference that $20,000 amount. In fact, I'm going to carry that same amount over to the other 3 columns. So the projected cash excess or deficiency, if it's negative, we have $85,270 more than we need. So we don't need to borrow. And of course, we don't have any principal repayments to worry about. So the effects of financing are 0 as well. We can sum these 3 up. Our ending cash balance is simply $85,270. Now that becomes May's beginning cash balance. So let's do that. We already dealt with the cash receipts. So we have cash available of $867,610. We subtract out our cash payments, we have $8,960 left. So we're positive. That's good, but it's not good enough. We wanted to have $20,000 of cash available. We don't have it. So when we subtract those two, we are $11,040 short of where we wanted to be. So what that basically means is we are going to borrow $11,040. Now, we don't have any principal to repay. So the total effects of financing are going to be the positive $11,040. So our ending cash balance is going to be basically the $89.60 plus our effects of financing. So that gives us exactly the $20,000 that we expected, which becomes the beginning inventory or beginning cash balance for June. So June, the cash available is $1,048,000 minus the cash payments. We're positive, but we're not positive enough. So what we're going to have to do here is subtract the 2 again. Now we need another $10,640. We don't have enough to repay any previous principal payments or interest. So our ending or total effects of cash balance or total effects of financing are going to be $10,640, and our ending cash balance is going to be the $93.60 plus the $10,640, which again gives us an ending cash balance of $20,000, which also becomes the quarterly ending cash balance. The quarterly beginning cash balance is the first month of the quarter. So that's what we have there. Now, I do want to make one tweak just to talk about what we would do if we ended up having enough cash to pay some of that off. So I'm going to go ahead and just make a quick tweak to do something. I'm going to say we have, just going to overwrite that. Now we'll change it back in just a bit. So that means we had $61,200 before financing. We only needed $20,000. So we had $41,200 left over. We don't need to borrow this month anymore. In fact, we have plenty of money to repay the principal from last month. We're also going to calculate interest, which is the 1% multiplied by $11,040. We'll be paying $110. So we had $61,200, but we're paying $11,150, so that would give us our $50,050, which would carry over to this ending balance. That's how you would do it if it worked out that way, but in this particular problem, it didn't. So we were left with borrowing another $10,640, and we're good with our overall cash budget. We have two things left to worry about: the budgeted income statement and the budgeted balance sheet.